In 2025, the U.S. economy is sending deeply conflicting signals. Corporate earnings reports show remarkable strength, yet nearly 60% of Americans say paying down credit card debt is their top priority. Growth rebounded in the second quarter, but consumer sentiment has fallen for the first time in 4 months. What is really going on? The answer lies in the data, and it points not to a crash, but to a complex and challenging slowdown that will define the year. We'll move past the headlines and dive deep into what the current economic data really means for you. We will explore how lenders are adjusting their strategies, how to build more durable income streams, and how to position yourself for long-term growth. Section 1. Understanding the 2025 economic landscape. To build a solid financial strategy, we first need to look at the real data shaping the U.S. economy. It's a mixed picture. The job market appears stable, with unemployment projections holding steady around 4.1%. However, this broad number masks a slowdown in sectors like tech, while demand remains strong in essentials like healthcare and logistics. The real pressure point for most households is the nature of inflation. While the overall rate has cooled, the cost of services, rent, insurance, and healthcare continues to rise faster than wages, with service inflation persisting at over 5%. This is why many feel financially squeezed, even with a steady job. Your paycheck is buying less of what you truly need each month. At the same time, household finances show signs of strain. Revolving credit balances are at a sustained high, suggesting more families are using credit for monthly expenses. This doesn't signal a collapse, but it does mean less financial flexibility for the average American. Understanding this environment, a resilient job market undercut by persistent service inflation and rising debt, is the first step toward making smarter decisions. Section 2. Proactive risk management by lenders. When the economic outlook is uncertain, banks and credit card companies engage in proactive risk management. This is a standard business practice to protect their own stability, but it can directly impact your finances. To minimize potential losses from defaults, lenders often adjust the credit lines they've extended to consumers. They might reduce your credit limit even if you have a perfect payment history. This is important because it can instantly spike your credit utilization ratio, the amount of credit you're using divided by your total available credit. For example, if your limit on a card with a $3,000 balance is cut from $10,000 to $5,000, your utilization jumps from a healthy 30% to a concerning 60%. This can lower your credit score, making future borrowing more expensive or difficult. Actionable strategy: get ahead of this now. First, review all your credit accounts and know your utilization ratios. If your ratios are low, consider requesting a credit line increase while the economy is relatively stable. Lenders are more likely to approve such requests now than during a downturn. Second, focus on lowering your overall debt-to-income ratio, or DTI. A lower DTI makes you a less risky borrower and provides a powerful buffer against a lender's risk management decisions. Section 3. Rethinking your income streams for resilience. The dream of passive income can be fragile. During economic downturns, consumers cut back on discretionary spending, which can hurt income from affiliate marketing, ad revenue on lifestyle content, or even dividends from cyclical stocks. The key isn't to abandon the idea of multiple income streams, but to build ones with greater resilience. Let's focus on 3 categories that perform well during times of economic pressure. Digital products that solve problems. Create an ebook, course, or digital tool that helps people save money, learn a valuable job skill, or make their business more efficient. These products have a clear return on investment for the buyer and are seen as a necessity, not a luxury. High-value freelancing and consulting. As companies cut costs, they often replace full-time hires with specialized contractors. If you have expertise in an essential business function like bookkeeping, cybersecurity, or digital marketing, you can market your services to companies seeking flexible, expert help without the long-term commitment. Finally, peer-to-peer lending with diversification. While not risk-free, modern peer-to-peer platforms allow you to act as a lender to a large number of vetted borrowers. By investing small amounts across a wide portfolio, you can create a durable income stream and minimize the impact of any single default. The goal is to shift your focus from purely passive income to durable income sources tied to essential needs and skills. Section 4. Strategic asset accumulation during market corrections. Market volatility is unsettling, but it's also the primary source of opportunity for long-term investors. Successful wealth building isn't about perfectly timing the market. It's about consistently investing when quality assets are available at lower prices. Instead of panicking, disciplined investors stick to a plan. The most proven method for this is dollar cost averaging, or DCA. By investing a fixed amount of money at regular intervals, for example, weekly or bi-weekly, you automatically buy more shares when prices are low and fewer when they are high. This strategy removes emotion from investing and lowers your average cost per share over time, significantly enhancing your potential returns when the market recovers. Your 90-day action plan for strategic accumulation. Fortify your foundation, days 1 to 30. Before investing, secure your personal finances. Ensure you have an emergency fund covering 3 to 6 months of essential living expenses. This cash reserve prevents you from ever being forced to sell your investments at the wrong time. Identify your targets, days 31 to 60. For most people, the best targets are low-cost, diversified index funds or ETFs that track the broad market. These provide exposure to hundreds of companies, minimizing single stock risk. Finally, automate your investing, days 61 to 90. This is the most critical step. Set up automatic weekly or bi-weekly transfers from your bank account to your brokerage account. Even small, consistent amounts will grow into a substantial portfolio over time. Section 5. The Skills Dividend, future-proofing your career. Your most valuable asset is your ability to earn an income. In a shifting economy, you can create true financial security by investing in your professional skills, an approach I call earning a skills dividend. This is about making yourself so valuable that you remain in high demand regardless of the economic climate. Certain sectors are historically resilient. Fields like healthcare technology, cybersecurity, and logistics often grow even during slowdowns. Skilled trades, electricians, plumbers, mechanics, also remain in constant demand. The key is to look where the needs are greatest. How to start investing in yourself today. Identify skill gaps. Research job postings for roles you want in the next 5 years. Note the required skills and certifications you don't have. Leverage low-cost learning. Use platforms like Coursera, edX, or LinkedIn Learning to gain in-demand skills and certifications affordably and quickly. Finally, build your professional network. Actively engage in your industry's online communities. A strong network is a powerful tool for discovering opportunities and gaining career advice. Continuously enhancing your skills is the ultimate strategy for protecting your income and building long-term career security. Navigating this economy requires a proactive mindset. The strategies we've discussed today are designed to put you in control of your financial future. Now, I have a question for you. What is the single biggest action step you plan to take in the next 30 days to improve your financial position? Share your goal in the comments below. Reading the community's plans can inspire us all. If you found this helpful, don't forget to like, subscribe, and share it with someone who's concerned about the 2025 economy and wants to grow their wealth.